A few common mistakes that I see from time at both Acumen and Bridges is founders get fixated on the valuation when they really should be thinking about who the partner is. And obviously as an investor that sounds self-serving, but we see a lot of companies that have raised money at valuations that aren't really sensible at the time they raised the money, and they're still not very sensible 18 months later. And it just makes it that much harder for future investors to think that there's an opportunity to invest on a rational basis. Founders will raise more capital than is prudent. So, if you can avoid it, raising as little capital as possible while you generate as much from revenues as possible is the best solution, because the expectations that come with that investor capital, that venture capital typically, are growth that may not be achievable with the little amount of capital that you've raised. And so, again, we now at Bridges are looking at mostly businesses that have been able to bootstrap their way to sizable revenues and profitability without that external capital. But raise as little as you can, and do so on valuations which are not kind of punitive to you as the founder owner, but don't try and drive the price up so high that it makes it impossible to fundraise in the future, and creates a sort of a misalignment between the investors and the management team around expectations of growth and exit. You want a partner, you don't want an adversary around the table, and the more you're kind of negotiating price, the more you're bringing in an adversary as opposed to a partner.